So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome back, everybody. This is the Are You Effable podcast, where you find out, you learn, you discover how to make your personal and business fundable. In this episode, we're going to be discussing, and you are going to discover, how your installment loans create an almost impenetrable fortress against negative or derogatory accounts if you know what you're doing, right? If you know the rules of the game, you can win the game. So we're going to be talking about how installment loans contribute to your personal profile and the positive results or the negative results that occur based on how you manage them. So I will see you right back here in just a moment. Aha, welcome. In this episode, as I said, we're going to be discussing how your installment loans and those behaviors really trigger positive points and create resiliency in your personal profile. So first of all, just like we talked about on your revolving account portfolio, remember we said that there is a message that revolving accounts send, right? It says, look at all the money I have access to, and yet how responsible I am. Well, installment loans matter because it sends a completely different message. It says, look at all the money you gave me. All this money, house loan, car loan, student loans. You gave me all this money in one lump sum. And look how faithfully I'm paying it back. Boom, boom, boom. Now, this, of course, is presuming that you're paying it back faithfully. But the message is, look how faithfully I pay it back. If we know what we're doing on these installment loans, guys, we're going to create a foundation of powerful credit reporting, right? Let me give you an example. So I think of installment loans like the ballast in a boat. Right? The ballast is that part deep in the keel. They have weights, right? Back in the day when they had the schooners, the 16th, 17th, 18th centuries, they had these all these ships that had. That's where they kept their cannonballs. And when they ran out of cannonballs, they'd have to find rocks to put in there because you want to be able to turn your ship without sinking in the water. If you don't have enough ballast, as you can see, you can tip this boat. So ballast is everything, and loans create that heft, that center of gravity, that heaviness that keeps your profile deep in the funding waters. All right? I know I'm a metaphor guy. I know I'm pushing the limits here, but I'm telling you, FICO actually counts the total number of positive payments on all of your loans. Now, if you have a thin file, right, as we've discussed, a thin file at less than 20 total accounts, open or closed, good or bad, but less than 20, you're characterized as having a thin file. This thin file then has measurements that a 30-day late or a collection account or a lien or a judgment, they all count heavily against that because you don't have enough accounts and you don't have enough months of positive payment. A thick file where you have 20 or more, and let's presume that you've made all your payments faithfully. You had several or numerous home loans, you've several or numerous car loans, all paid perfectly. That every single month that you make that payment, you are putting you're putting more weight, a cannonball, a rock in the keel of your boat, and you are creating so that it sits deep in the funding waters. Okay. Then, if you have all of this ballast in your credit profile, then if you have a 30-day late, it may affect you less. You may take a 20 or 30 point hit rather than a 50 point or 100 point hit, because that 130-day late is a percentage of all the possible times that you've paid on time. And FICO gives you credit for all those positive payments, all right? So it is insanely important to not only have the right loans, but pay them on time and accumulate all of these positive payments. Now, let's define, just like we did with revolving accounts, let's define what an installment loan is, all right? An installment loan comes in basically various vehicles, but it's only one kind of credit instrument. It has a fixed loan amount, a fixed payment amount, and a fixed term, which means the term is the payback period with 24 months, 36 months, 48 months, 60 months, it's 72, etc. That's it. If it has a fixed loan, fixed payment, and fixed term, it's an installment loan, not a revolving account. So many people confuse. They just think credit is credit, and it's not so. You've got to understand your loans are one thing, and your revolving accounts, your credit cards, etc., are something completely different. Now, what is the perfect installment loan portfolio? There are two very important features to your installment loan portfolio. One, we prefer Tier 1 100% value installment loans. That's the preference, just like we prefer Tier 1 revolving accounts. The other thing is there are minimums that are I want to say suggested, but they're not suggested. They're required by FICO to capture the most number of points. For example, FICO, just for having a home loan, just for having a mortgage on a credit report, you're going to get 15 to 20 points. It doesn't matter if it's 1 day old or one reporting cycle old. You're going to get 15 to 20 points. Same with an auto loan. You're going to pick up 15 to 20 points just for having an auto loan. Now, I cannot tell you how many students and clients have complained to me, or my team members. They're like, hey, I just paid off my car and my score dropped 20 points. And I'm like, have you paid attention in your Funding Hackers Bootcamp? Did you watch your client videos? Because we say specifically, and I'm telling you right now specifically, that an auto loan needs to be on your profile to round out the loan mix section of FICO's scoring model, and as a result, lender underwriting models, okay? You don't have to have an auto loan, but you get penalized for not having one. You don't have to have a home loan, but you get penalized for not having one. Okay? I'm just telling it like it is. I don't know of a single client who has an 800 plus credit profile without that have neither a home loan or an auto loan. Doesn't happen because that's part of your loan mix. Now, technically, it doesn't matter how big the home loan is. If it's a $50,000 or $100,000 home loan, as long as it says mortgage or real estate loan, you're set. It doesn't matter if it's a $5,000 or a $2,000 auto loan. As long as it says auto loan on it, you get credit for the loan mix section of the profile building. Okay, so here's the other thing, though. The bigger the loan amount, the more valuable it is. You don't get more points for having an expensive loan in the loan mix section, but you get more underwriting points for being able to handle higher loan amounts. This is important if you're trying to build your profile and optimize it for business lending, because if you want $50,000 and $100,000 business lines of credit, but the max amount of credit you have is a $20,000 auto loan and no mortgages, it's unlikely you're going to get a $50,000 or higher business line of credit, because there is no evidence you know how to handle that amount of a debt instrument. Does that make sense? So we want one home loan and we want one auto loan wherever possible. This is vital. Now, are our loan installment loans created equal? Again, The answer is a resounding no. So let's go through the same metrics that we did for revolving accounts. Again, we have at the top, we have tiers. That's the value of the financial institution. Tier 1 is the best. Tier 4 is the least. And we have the instrument values again, 100, 80%, 60%, and 40%. So if for those of you who are viewing this, if you're listening, we'll describe it in great detail as possible. Go to fundinghackers.com blog and find the pictures that we have there, the graphic illustrations that outline all of this. Tier 1, again, is Bank of America, Wells, Chase, and Citibank. But each one of those institutions can have what are called flex loans. And a flex loan is more a marketing gimmick. Be aware, if you're still receiving offers, what do we say? Do not take advantage of a credit offer. And many times for installment loans, flex loans will be offered to you via mail or contact from your banker, etc. The other thing is that there are 40% versions, departments, or divisions of the Tier 1 banks. Wells Fargo Financial may carry a premium interest or a high interest or the subprime auto loans. Bank of America, Citibank, Chase, they change all the time, but many of these banks have a division that offers loans for higher interest rates, right? And those loans are what are called subprime loans. The Tier 100% are prime loans, and the 40% are subprime loans. Now, the same banks and institutions fall in Tier 2 for installment loans. You got U.S. Bank, KeyBank, PNC, Santander, all the regional banks are Tier 2 100%. But Discover, American Express, and Capital One Online also offer loans, okay? They're usually higher interest. They're subprime loans, and we give them at 80%. And some of these same regional banks have subprime divisions. You got to be, if it ever says financial, you know you're going to be paying a higher interest rate, and you're going to be working with the same tier, but a different value contribution of the loan. Remember, we prefer, wherever possible, we prefer Tier 1 100% loans on your personal profile. On the business side, it's way more liberal because they don't track the value contributions of the different tiers on the business side yet. FICO's is moving in that direction, but they do not do so yet. So just remember, guys, if it says financial in the name or financial services as part of the name of that institution, then you are in a separate division of U.S. Bank or KeyBank or BB&T or whomever. So look for financial services. Usually financial services is not part of a revolving account. It is only for subprime lending. All right. Tier 3, same thing. You got the national scope credit unions and federal savings and loan, USAA, Penn Fed, Navy Federal, and then at 100%, and then at 80%, you have the community banks and the credit unions. So any loan coming from a credit union that's local to you, and local can mean multiple states, but it's local. It's not a national scope credit union. They're going to be Tier 3, 80% contribution to your profile. Now, here's where it gets... I've had clients, students complain that this isn't fair, all right? And so fair is not a thing in financial, in the funding game. Fair is what the lender is willing to do for the lender based on how good the borrower looks. So, looks on paper. I would say how they look in the mirror, right? Right? How they look on paper. What's their point value, right? Going back to the NBA player parable, the NBA draft. Do they have stats that where one of these lenders want to draft them onto the team? And that is the only thing that matters. It's not fair that somebody doesn't make the NBA draft. They didn't make the draft because they haven't got game. They haven't got the stats. They haven't got the proof. So it's not about fair. But I do want to tell you that where on tier 4, Ford Motor Credit, Toyota Motor Credit Corporation, Honda Financial Services, Yamaha, just like these financial services companies have revolving accounts for motorcycles, ATV, wave runners, etc. You know as well as I do that they also have installment loans, and most of these are auto loans. They could be boat loans depending on what they are, but auto loans. So we think we're getting a good deal because Toyota Motor Credit Corporation is offering 0% interest. And we're like, I want that deal. Well, I'm going to tell you something about that deal. Do you realize rarely does a dealership, an auto dealership, offer financial financing? Rarely does an auto dealership offer financing where they either say 0% interest for 60 months or whatever it is, or cashback rebate. A rebate you can apply to the total of the car. The thing is, guys, if you do the math, I have not seen once where the free interest, the 0% interest, doesn't exactly match the rebate offered in cash against the purchase of the car. It's the same. So don't get your undies in a bungee because Ford Motor Credit says, yeah, I'm gonna give you interest-free financing, and I'm telling you it's a tier 4 institution, and it is not, and it will show on your credit profile as a consumer finance account, and FICO will downgrade its fundability. Take the lowest possible interest rate and take the cash rebate. They're the same thing, but take the rebate and then get a better institution to finance the automobile. Are you following me? Right? The rebate and the 0 interest come out to be exactly the same or very near the same. If you can qualify for 0 interest, it requires a certain, usually it's tier 1, 720 or higher credit scores. If you qualify for 0% interest, then that same interest rate is going to get you the best interest rate possible that's going to equal the rebate. So I'm telling you, it's so easy to take advantage of, but these are tier 4 finance companies. They're finance companies, and finance companies always downgrade or degrade the fundability of your credit profile. Your borrower profile sucks when you have these on here. So take the rebate and move on. Then down here in the equivalent of our retail merchant cards, the mall store cards, etc., we have the Synchrony Financial, Quandra Consumer Finance, Loan Factory. All of these are the tier 4, worst of the worst, 40% contribution. These are actual finance companies. Do you realize that one of the FICO criteria is an inquiry of a finance company? If you try and get an inquiry or try and get financing from one of these, or remember, these are not complete lists. These are not the only participants that go on. These are the types and kinds, right? FICO actually downgrades your fundability when you even apply for one of these tier 4 institutions. You didn't know this either, but if you go for a check guarantee and not a check guarantee, if you go for a check cashing, where they pull your credit, like a cash advance or a title loan, and you pull an inquiry, that's an extra huge doc on your credit profile, and FICO penalizes you and passes that along to all the underwriters, underwriting software. Guys, where you're looking for money, the quality of the money you're looking for is crazy important. You cannot just think, oh yeah, let me go grab some new credit. In a couple of episodes, we're actually going to be talking about spirit animal totems, credit totems. Think of it as the horoscopes of financial animals, right? These animal totems are represent the unconscious behavior that FICO and the underwriting software measures, and we'll be able to talk about this. I'm going to come back in that episode, and I'm going to talk about what kinds of animals, especially the animal totems that look for this kind of credit instrument. So guys, be wise, be aware, take care of yourselves and each other. Make sure that you're doing everything you can to be effable, because all the financial success in the world comes when you are effable. It's been a pleasure spending this moment with you. I will see you next time. Have a wonderful day. Hey guys, thank you for listening to Are You Effable? Please leave comments, because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.